Hi everyone, it's Tarek here. I wanted to talk today about a couple of titanium dioxide companies and the potential for possibly entering them soon. This is a market that has been soft for a number of years now, and I'll talk about three players in this sector. But we can look at one of these companies, Tronox, and they describe that for titanium dioxide, they have mines and that where you get titanium, and they process the titanium ore and zircon and other materials, and they create something called titanium dioxide pigments. And these are used by customers to add brightness and durability to paints, plastics, paper, and everyday other products. And that's the core. And this industry has been problematic because there's been a lot of entry. So what happened is that prices spiked in, which company can give us? So you can see here, this is Kronos. So there's the three companies are Tronox, Kronos, and then Chemours that I'll talk about. Kronos has a longer price chart. So Kronos, in the early from 2009 up to 2012, what happened is that these participants were raising the price of titanium dioxide in the market quite rapidly, and in part there was more demand than supply. And what this did is it triggered growth in supply. So it attracted entry, particularly from China, which now contributes to about 30% of world production of titanium dioxide, and they weren't very major beforehand. So this is one thing, is that people see a run-up in an industry because those participants can raise price and their profits and cash flows look very good. But then if there's no moat in this industry, then you'll see entry, in particular entry from low-cost countries. Perhaps in this case it's not really labor, but it came from China, and that affected prices. And so since 2012, really, the price of the titanium dioxide has been falling, and these companies have entered into distress. And so that's why I'm looking at them to see if there's an opportunity here. And what makes me think there is something going on is that you can read here, I think it's here. So Tronox says in their latest presentation on their investor relations website, they say Q1 marked a turn in the titanium dioxide pigment selling prices. March selling prices higher than February. So prices had been falling, and now we're seeing some price increases. So pricing was believed to be unsustainable or below the fair value or sustainable value for the industry without some sort of reassessment of supplies, which could be bankruptcies by participants and so forth. So price is coming back, and what happened is Chemours, which is one of the larger producers in this market, which is it's in a U.S. company, they started to raise the price, and Tronox followed, and others followed. So that's a promising sign. Seeing prices rise, and if the market adopts those higher prices or still buys the product, then you can see cash flows improve, and that's a sign for a turn. And they're seeing these pigment selling prices rise globally, and they expect sequential price improvements going forward into 2016. And they say that here they talk about supply demand. We've reduced the pigment inventory. So these companies have been producing the inventory they've been keeping as a way to generate cash and reduce costs. If the inventory is already sort of work in progress or finished product, so if you can sell it, you can raise cash without really having to outlay the money to generate the inventory in the first place. So it freed working capital, generating cash, which is what I just said, and global industry production capacity in both these areas have been shuttered or curtailed in the last 2 years. So these commodity cycles take multiple years. A lot of people don't realize that either. And so in this case, it took 2 years to see capacity in the industry decline. And now you have low inventories at most of these companies, below normal levels, they say, which is a good sign because that means that as demand picks up, there could be a situation where demand and supply are no longer balanced, and in that way, demand might exceed supply, and you'll see prices increase, and the commodity cycle will probably continue. So, what I don't necessarily like about this company and this industry is that there isn't much of a moat protecting you from competition, which is highly desirable. It's evident, right, that the Chinese entered and new players entered, and that caused the prices to decline. And there's a lot of still capacity that's not utilized. A lot of utilization rates are quite low. So the other thing you want to pay attention to is how much of these factories are being used. If utilization is 100%, that means everything is being used in the factory. It's running on all cylinders. But in this case, you'll see utilization much lower, maybe around 50, 60%, which is problematic because as demand increases and prices increase, it's very easy for participants to increase their utilization, which they want to because then you have better economies of scale, or you can spread your fixed costs over more product that you output and sell, and so your margins will look better. And there's no coordination in this industry between the players. So you have a number of players, some in China, some which you're not going to coordinate well with, and in the United States there are a number of players. I'm talking about 3 of them. And if there's no coordination between them, like we might saw with sort of OPEC back in the day, then you won't see supply cut, and therefore you won't see dramatic swings in probably titanium dioxide price, which is a negative characteristic of this industry. So as Chemours introduces price increases, I think those are sticking because prices were unsustainable for most people. So everyone is interested in following suit and raising price, and these participants they're somewhat weak and they can't afford to battle it out like Saudi Arabia is in oil by overproducing and driving out low-cost suppliers. So Chemours, which is one of the biggest players, has a lot of debt, and therefore in order to be sustainable, they need these price increases. So you have the biggest player needing the price increases, and all the other players are also distressed. So everyone's going to raise price until it's sustainable. But I don't see price going up too high because there's a lot of excess capacity, a lot of utilization that's low. Still, utilization rates are low. And until we get into a sold-out mode where demand outdoes supply, I don't see this industry generating crazy profits. But that's okay. For a value investment, we don't need crazy profits. We need to see dollars trading at 30 cents and feel comfortable about achieving that value gap. So I think my point here is that the industry is at a turning point. Prices have been falling, but now recently they started to pick up, and they seem to be targeted to pick up for the rest of 2016. It seems like it's credible. Chemours, again, has a lot of debt. They need price increases to sustain. A lot of the industry participants are distressed. They also need the price increases. They're following suit. But I don't think there's going to be there's not going to be a situation where demand outstrips the supply because utilization rates are still low. But I think there is coordination here because of the distress. So that's my point. Now let's look at each of these companies quickly. So Tronox. So Tronox was trading in early 2015 around $24, $25. It now trades at $4.50. It was recently as low as $3. And they don't have their financials on Google Finance for some reason, but this company is quite leveraged. So it has roughly $3 billion of debt, 2.9 net debt, and you can say the equity market cap here is 318. So about 10% of this company is equity on a market value basis, and 90% is leverage. So it's quite leveraged on a market value basis. But this company is not a pure titanium dioxide producer. They also they have an alkali division. So let's go back to the presentation. So they talked about we looked at the titanium dioxide. So what happened is in 2015, this company acquired a alkali company, and they paid about $1.6 billion for it. The transaction closed in April of 2015, and as a and this business is doing quite well. It produces soda ash, which is used by glass makers and detergent makers and some other chemicals. So it's quite a diversified customer base, which is always nice. And it's been selling in a sold-out mode, which means demand is outstripping supply. So this industry is doing well, and they seem to own the world's largest producer of soda ash, as you can see here. So yeah, selling in a sold-out mode, and they have a structural cost advantage, they claim. So what's nice about this business is it's actually producing a lot of free cash flow. They said that it produced about 150, and I was looking at their conference call. So selling in a sold-out mode, their alkali business, and the first 12 months of having it in the portfolio, they've generated about 156 million in free cash flow, which is pretty good for a company that was just acquired. And if you look at that relative to what they paid for it, they got about 10% yield, free cash flow yield, which is pretty high for the business. So it means in about 10 years, they'll have generated enough cash to have paid for the entire business. So that's nice. And it's nice also because they've diversified their business while the titanium dioxide part of the business is having losses, this part of the business is having positive free cash flow and is able to help stem the distress. But ideally, from a theoretical point of view, it would probably be better if these two different business models were not under the same roof, because there doesn't seem to be obvious synergies between them. So I think right now what you're seeing is a positive business subsidizing a losing business, and that may not be the best use of those funds. So this is from a side note, this could be why there's such a thing as a conglomerate discount, where conglomerates trade at 20% less than they would at some of the parts valuations. So that's Tronox. Tronox has, again, this alkali business and the titanium dioxide business. Then there's Kronos. Kronos is a pure titanium dioxide player, and let's double check. Yeah, they're pure titanium dioxide, and they have been around publicly the longest. And what I like about Kronos is that they have much less leverage than everyone else. They have about, on a book value basis, they have maybe 20% leverage. So you can see their long-term debt is 340 million, 50 million, and that's relative to their assets of 1.2 billion, and they have equity of about 454 million. So if we do the market value of equity per share, so 454 divided by, we go back, they have 115 million shares outstanding. Okay, so it's about trading at $4 per share, or on a book value basis, but it's the stock price is trading at so not really a discount. It's trading at a premium, 571 per share, and so it's fallen. It fell from 12, say, to 6 now. So it has fallen 50%, whereas Tronox has fallen from 24 to 4. It's fallen a lot more, and it's in part because Tronox has a lot more leverage, right? They're 10% equity on a market value basis. So Tronox is definitely more risky than Kronos. And then you have Chemours, which is the largest of the three. And this has actually bounced back. So they went public, actually. They were spun off from DuPont, which is a big chemical company. And they went public with a lot of debt, and the market went south, and the stock went south to 3. But as they've issued these price increases and achieved those price increases, we've started to see the stock bounce, and it's now bounced up to 10 from 3, which is amazing for 3 months. You're seeing 300% return almost. But what's interesting is recently Citron, which is a famous short seller, came out with a blog saying that Chemours is worth 0. And Chemours is very leveraged, kind of like Tronox in that sense. It's very leveraged, and potentially has a lot of environmental liabilities, is what Citron is claiming, which will bring it down. And they also claim that it was spun off so that all the environmental liabilities would go with Chemours, and the other DuPont businesses could avoid these liabilities. So Chemours is the largest producer also, and relatively speaking has bounced back. And if we look at their equity to book, the price to book here, let's go to the balance sheet. That'll help. If you see here, they have 188 in equity, 181 in common stock, so there should be about $1 on a book value basis. It's a recently public company, so most of the assets have been valued recently, and they're trading at almost 10 times. So this seems kind of expensive from that metric point of view. Kronos seems kind of expensive from that metric view, and we haven't done it yet with Tronox. But Tronox, if we take I have their financials here. I just pulled up their Q from the SEC's website. If we go to their assets, this is the balance sheet. You can see their total equity was 1046, and their share count, you can also get this from Google Finance, or it should always be on the first page of the filing. So you can see here they have ordinary shares and B ordinary shares. So they have about 65 plus 51. 65 plus 51 shares. So they should be worth about $9 a share, and they're trading at about half of that. So they're trading about 50 cents on the dollar. So of the three, Tronox seems to be more of a value investment, but it's quite leveraged. But what's also nice about this is that they have this positive alkali company, which is a sold out business and generating a lot of free cash, 10% yield on the purchase price, and that's a positive that helps them meet their debt obligations. And they don't seem to have any covenant problems yet. And with the price increases, you could see again a turning point in this industry. The other thing I always like to check, as you've seen on the past calls, is the insider buying. And what attracted me to this industry also is I see very, very consistent insider buying by the industry participants. So, for example, with Tronox, you can see that in 2015, as the price started to decline, you could see consistent insider buying at fairly meaningful levels. You have the CEO and chairman of the board, Thomas Casey. He bought in March. He bought $400,000. Then, and that was at around 20. He bought another $400,000 around 19 in May. And then he bought another $400,000 around 10, which is about half the price, in August. And then he bought again. So that was the last time he bought. So last time he bought was August, which is right around here, July, August. And so he was catching the falling knife, which managers often do. They're often early. So it's good to really think for yourself about, is this business turning around, or is it still got farther down to go potentially? and it went farther down below. And what did bother me is I didn't see very aggressive buying at these low levels. I see some purchases in February and March from a board director and a vice president, but these are only around, if you look at this column for value traded, these are only around $10, $25, $30,000, right? This is nothing. For these guys, if I really thought that they thought that this market was going to turn, I would have expected them to be buying much, much more aggressively. Of course, they lost money on the way down because they were buying earlier. The same guy, Van Nierkerk, he was buying up at 20 as well, right? So he was buying his shares at 20, and it seems like back here he also bought around $20,000, and he bought again $20,000. So he seems to buy around $20,000 at a time, but still, I would think that if you really thought the price was cheap and trading at half below book value, you'd be a little bit more aggressive. So, this is good. I like to see that they're buying, but it's not as exciting as it could be if they had maybe posted $1 million purchase here. But what's nice is I see the same thing in Kronos. So one term here. So the fact that you see multiple insiders buying, that's called cluster buying. So you have a cluster, multiple executives on the company who are buying, and that's usually a good sign. I have a lecture series on my mini MBA channel about insider buying and how to interpret it. And there are 4 lectures, and I talk through this, but just quickly, if you have one person buy, you have one person and their bias and their judgment. And we know that people have a wide variety of opinions. And it could be that they're wrong, and it's kind of weird that no one else in the company shares. If it's one person buying only, it's kind of weird that no one else in the company shares that person's enthusiasm, right? And opens up their pockets and buys shares. What's nice here is I see not only the chairman of the board buying, Thomas Casey, but I also see all these other people buying, the CFO, the senior vice presidents, executive vice presidents, board members. So that's good. And there was one sale, but it was a tiny amount of shares by Fine Capital. So relative to what they have, which is 6.5 million shares, they sold 60,000, so nothing. So no real insider selling. And then again, if I go to Kronos, what's even nicer is I see not only buying at Tronox, but I see buying at Kronos, which suggests that this industry is about to turn. So you can see here in March, you see again $30,000 purchase, $25,000 purchase, and you see those in January of this year. You see them at the end of the year. You see just very consistent, regular buying for these company. And it's again a lot of it is by the chairman of the board. So top ranks, just buying on a regular basis. It could be that every paycheck he gets, he just puts in money, and something like that. And there's other people buying. So it's not just Stephen, it's also Clemens he bought. And there's another director, Thomas Stafford, who made a purchase, tiny purchase, I guess. And then Chemours. So at Chemours, which is the other large one, we also see a bunch of buying. So really, this industry does seem like it's about to turn, which is what made me fairly bullish on this sector. Now, in terms of our valuation analysis, it looks like Tronox is the only company that's really trading at a discount and to book value of equity, and the other companies are a little bit more expensive, but Kronos is much safer, so they have a lot less debt. And I think that is very important because you never know how long this distress will last, and you really want to be able to go from here, from 3 to 30. You want to make 10 times your money in 2 years, and so this is potential. Like this sector could move up 5, 10 times, and Kronos could go back to 30, and that would be a very nice return. And Tronox would also be able to participate, but Tronox would go a lot more, but they're more leveraged. So I think Kronos is the more value investment in some sense, but I would want it to fall back down towards 4. Remember, we calculated the price to be around 4, so if I could get it at book value, that would make me much more comfortable buying Kronos. And with Brexit and so forth, maybe there's enough volatility to get it back down to 4. Tronox, I think, is already at a discount, and you can see it's somewhat stabilized. So it was falling, but for most of this year it's been flat, and there's some enthusiasm for the stock. Recently it brought it up to 8, and it's tapered off, but it seems again to be somewhat flat right now. So I think timing-wise, this is not a bad place to enter Tronox, but I wouldn't mind waiting to put my full position until I see either some more improvements in the industry, or possibly the price going back down, or just staying level. So if there's more consolidation, I would believe I would make a fuller position. But this is promising. And then what else was I going to say? So I've highlighted the Citron Report. You can go to citronwebresearch.com and you can click and read it. So there's still some overhang here, but they targeted Chemours, and Chemours, trading at 10 times book value with a lot of debt. It is the biggest, but with the Citron, with a short seller attacking the company, you never know if they're going to release something that's specific to this company that's very negative, and so there's a lot of headline risk involved in this company. So I think it's not exactly cheap from a value investment point of view. There's headline risk. It has a lot of leverage, and it's already quite high. I would rather get a company that's still low, wait for the market to kind of turn some more, start to build my position, and then make it more of a full position in the coming months. And that's all. I think the insider trading at all 3 of these companies, the cluster buying, that's a very positive sign. And then all of these companies, I looked at the investor presentation, I showed you that, and they have a business that's selling in a sold-out mode, but their titanium dioxide business, they say, seems to be turning. There seems to be some price increases which are going through. Seems like their inventory levels are low. So I think there'll be some recovery. So I'm not predicting that titanium dioxide will be a hot market, but I'm predicting that prices will go back to a more sustainable level. And then these stock prices won't trade at such distressed prices. You could easily see this trading above 10 in the next couple of months, and maybe even towards 15. So 3 times your money, and if there's enough volatility from Brexit, you could probably get it around 4 or below even, and that would be, I think, a good entry point. But this is not a business to hold long term, because I don't think that the moat is very strong, and they're selling a commodity product, and they have competition from China, and there can always be new entry. So they're not companies with strong brands and strong moats. If you think otherwise, or if you have any other comments, please comment below. I'll respond. And if you want to get more updates on stocks and hear my thoughts, subscribe, and you'll get alerted when I upload some new ideas. And it's always nice to have you guys listen. I really enjoy engaging with you guys. So thank you for listening, and bye for now.